3, 2, 1.
What's up, everybody? I'm recording this because I had some interest expressed in how covered calls work and when would you use them or opt in for a strategy such as that. So I want to use Disney for an example, okay? And the reason for that is because I talk a lot about Disney and I'm investing in Disney, and this could particularly pertain to me, which makes it a little easier to explain. So Disney, I'm on the month chart right now. Now Disney hit a bottom of 74, 78.48, right? Now around this time is when I started to DCA into Disney stock position. I knew to do that because I seen previously, historically, 78.81 was a strong bounce level, and I've realized that across the board, right? So I started at that point, and I was telling everybody at that point, and then we ran it up for 300+% on options, amongst other things. Okay, so since then I've acquired almost 200 shares of Disney. Now, what's the problem? Well, Disney, of course, ran up. I was super excited when it ran up past 100. It didn't seem like it was going to lose any momentum, right? As you can see, pump, 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 and then we hit this wall at 122.42. Now, what can we see prior to that? That would have been an indication that this would be a strong wall or level of resistance, and potentially was a continuation towards the downside. Well, historically, right? Look at the level. So, where do they touch the most? Right around 116.98, and then we had one strong resistance point, 125. And technically, you can probably see some more historical data here. 120, yeah, right around here. So around 120. In that area, 120 to 124, you're starting to see a lot of strong resistance. At that point, I see that, and then I see this red candle here, which is a bearish indicator, right, of a potential reversal. At this very moment, I have a decision to make. I could either sell my stock for and just take my profit, or if I'm a believer in the company and I suspect it to retake, $200 or just keep running, then I hold on to my position, but I play something called cover calls. Cover calls is something that is a stock option strategy that you can play if you own 100 shares of a stock. With 100 shares of a stock, you can do something called writing a call, essentially selling call options. When you sell a call option, right, you are essentially putting your 100 shares up for sale for whatever strike price that you determine, like, or that you choose or select, right? But by doing that, you're also betting that the stock is going to go down. Why would you want the stock to go down? Well, you don't want it to go down, but if you're in a covered call, you're assuming that it will, and then what you're doing is hedging against your position. So you are signing up for a cover call, writing a cover call, and you collect something called a premium, which is cash money that you can use to put towards anything that you want, or you can withdraw or whatever you want, right? But what happens is the more the stock starts to drop or fall down, the higher the profit gain from that premium, and the more premium that you get to keep. Now, at the end of it all, you say, man, I really like Disney stock and I don't want to sell my 100 shares that I own. Well, you don't have to. You can um, you can buy back your contract at a lower price, right, than what you sold it for. And that's how you collect the difference of that premium, and then you bank essentially profit just from selling your shares. Now, so that's what it is. So I'm gonna stay on this menu quick, just to explain one more thing, and I'll show you what an option looks like. But essentially, if you know, let's just say, for instance, this is range bound right here, right? So from where's this at? We're at 84 to about 116, right? So you know that every time every time that Disney falls to about $84, it's likely to run up to 116 before it finds resistance and ready to fall back down again. If you can identify that pattern, then what you're saying to yourself is, man, I got 100 shares. Disney is range bound between $83 to 116. So I guess what I'm going to do is wait until 116 and sell some calls. So sell my covered calls. And then I'll ride that down and collect my premium, sell back or buy back that contract once we hit around the 86 to $83 range. And then you just do that, rinse and repeat. And all you're doing is collecting a premium at that point, and you're just making money on the 100 shares that you have. It is a great way to make money, especially when the stock market overall is flat or any stock is trading sideways or consolidating in a big way or a big range. So that being said, let's go into a contract. Okay. So let's go into options. So we're going to look at typically the best type of call option to get, or covered call options to get, is typically about 30 days out, right? It just gives you some wiggle room, and then you typically get a little bit more interest, you get a little bit more premium. The closer you are to the expiration, the less your premium. So let's say right here, this expires July 12th. Well, I want to sell a covered call. Right now, we're at $98. I'm going to sell a covered call at $98, right? For a $98 strike. So what this is saying is that, Rell, you are going to, if this contract expires, you're going to sell 100 shares of Disney for $98 a share. Okay, no matter what happens, right? But so what you would do, you would click on the call option, you would click sell, and then this right here is just like if you were to buy it, right? But you see there's a difference in the limit price. Okay. Okay. So what you do, you then click, let's just say this is the price we're going to go for, let's say $96, and then we're going to hit sell. And then what it'll show you is right here where it says estimate credit. See if I can get my little cursor here. Right here. That right there is the premium you collect right away. So as soon as you put your contract up or sell that contract, you receive $96 in your bank account or in your brokerage account. Okay? And that is your money. But if you sell the contract, right, or buy it back, then you would pretty much get to keep whatever the difference between what the going rate of that contract is versus what you originally purchased it for. Okay, right. So that's essentially that in a nutshell. Trying to think if there's anything else to add to this, but I think that pretty much covers it. But anyway, so the closer you are, right, the lower your premium. Now, you might say, man, Disney to me is worth more than $98. Like, I'm not willing to sell Disney at $98 strike. Well, then let's go 30 days out. 34, let's go August. So now look at you. Now, at $98, if you were to sell it, you collected $380 premium. So you get $380, and if you let the contract expire, then you keep the $380. Plus, you would have sold 100 shares of Disney at $98 a share. And that would be your total collected amount of money. Hopefully that makes sense. If it doesn't, let's talk about it in the comments. Any of these shorts that I post and you wanted to discuss it more, just let me know. This is Stocks for Rell. Take care.